welcome to the webinar. I'll move swiftly through the slide pack according to the agenda on slide 2, and hopefully you all have that slide pack by now. And I already have a few questions, so I'll make sure I have time to go through those at the end. So what we're covering today on the agenda on slide 2, the Australian equity market in 2014, a review, some comments on the global economic outlook, followed by the Australian economic outlook, and how that translates into the Australian equity market, the outlook, and what to expect from the earnings season coming up, which starts on Monday and is quite intense. Okay, so I'm moving forward now through to slide 4 for your reference, and just a review of 2014. The Australian equity market, as measured by the ASX 200 accumulation index, returned 5.6% for the calendar year. This was actually made up in components 1.1% in pure capital gains and the balance in yield. And it was quite a diverse market across the board, with such sectors as industrials posting 11% gains, financials 12%, banks about 9%, offset by energy down 12% and resources down 16%, clearly impacted by commodity prices. Across the globe, other markets also had diverse outcomes. In the US, the S&P 500 posted a gain just over 11%. The Nikkei, with lots of stimulus happening there, just over 7%. China was one of the big surprises with a huge rally, particularly in the latter half, up nearly 53%. And the UK off a couple of percent. So with the overall return of the market back to Australia of 5.6%, the actual earnings growth in the market was double that through fiscal 14 of 12%, and I'll come to earnings shortly. Cash profit was strong, and that was largely through cost control, with not many companies investing in their business and making sure that costs were under control, debts were repaid, and things were on track given the experience back in the GFC. A lot of companies are rewarding shareholders through higher dividends, and therefore payout ratios, which again I'll address shortly, were at record highs. Overall balance sheets were strong, and buybacks did start to feature through many corporates rewarding shareholders. So I think that type of trend will continue through 2015, but firstly let's have a look at some of the action in the market on slide 5. So what I've put here is on the left hand side just a relative performance, again looking at the overall market, which returned about 5.5%, 5.6%, industrials plus 11%, and clearly resources on the negative side down 16%. I thought it was quite instructive to have a look at the resource sector as a percentage of total market cap on that top right hand side. Back in the 70s and 80s, the Australian market was very much dominated by resources, and that's slowly eased off as the economy has grown and diversified all the way into 1997-2000, and then we've had a commodities boom through the early 2000s into 2008-9, where it got back up to about 30-odd%, and through commodity price pullbacks and clearly stock pullbacks, we're down to less than 16% on a relative basis in terms of overall market cap. Just looking at slide 6 and going through the major sectors over the last 10 years, it's been really, again, quite diverse outcomes. So just looking at the left-hand side, resources had a significant boom, and commodity prices as well, through the early 2000s up to 2008-9, particularly when China put all that stimulus in. And since then, the next few years were fairly modest in terms of performance by the resource sector, and you can see since 2012 that sector has certainly come under a lot of pressure, and in fact the banks have really taken over in terms of relative performance relative to the resources, and the bank sector, given the high dividend yields available there and the very solid balance sheets of those banks, you've seen some divergence in performance. Likewise, if I cross to the right hand side of that slide, looking at cyclicals in the blue if you have colour, but at the lower line if you don't have the colour slide, there's certainly been an underperformer relative to the defensive industrials, which include the consumer staples, healthcare, utilities, telecoms and the like. And that's really been the search for yield, which does dominate the market. and you've seen those defensive industrials outperform very strongly relative to cyclicals. This divergence, of course, creates opportunities, and that's the type of sectors that we're sifting through and looking to populate the portfolios. And given that divergence, some of the valuations, which I'll touch on later, have been stretched in some of those defensives in particular, and we'll go through that. Okay, just looking at some of the sector performances, which is slide 7, you can see across the markets the main, if you had a balanced type of fund, the divergence in performance, where the Australian REIT sector had a tremendous year, up 27%, far outperforming almost all other asset classes. We touched on Australian equity, 5.6%, international equity 15%, obviously benefiting from the Aussie dollar, and fixed income 9.8% with bonds rallying, and cash clearly with interest rates coming down only 2.7%. And I'll take the rest of that as read, but just of note in that REIT space, you've had a number of good years in particular as that sector recovers from a very dramatic experience in 2008, where that whole sector fell 50%, and nearly every company was recapitalised. And that sector is still well below historic highs of 2007, but nevertheless the key sector for a lot of domestic investors in terms of overall performance. I might move now forward through to the global economic outlook on slide 9. And it is mixed. Various regions are doing reasonably well and others not so well. One of the theses in our portfolio positioning is that the US economy would be particularly strong, and that's certainly been the case and has been the backbone of global growth. I've got a few charts coming up, so I won't delve too much into it there. But the key factors are that interest rates have been heading lower across the world. There's been attempts to boost economic output by quantitative easing, and that's as a result of some fragile recoveries, particularly in Europe, where the ECB is now responding. There's obviously been some geopolitical issues, particularly with tensions in Russia, in the Ukraine, which has led to a fall-off in confidence in some regions. China is adjusting to a new form of growth, and I'll touch on that in a minute. And Australian growth averaging around 2.7%, clearly with the non-mining sector, the mining sector weakening. Lots of cutbacks going on there, but the non-mining sector growing in compensation. And the Aussie dollar certainly a strong tailwind for earnings and industrials, and a bit of a cushion for resources. And an internal debate at the moment on interest rates. We view that interest rates are generally on hold, but again I'll address that in a moment. The bond market's telling us that there's interest rate cuts to come, so there's certainly potential to be lowered from here in Australia. Slide 10 just puts those comments in a chart, where you can see that from 2014, which we've clearly just finished, overall global growth still positive, 3.1%, and the forecast for 2015, these are generally IMF consensus forecasts, of 3.5% global growth. Those numbers have been lowered a little bit from their peaks of close to 4, but nevertheless you're still seeing positive aggregate growth across the globe, particularly from the advanced economies, and particularly from sectors of the developing economies, in particular China, which is coming off from its peak and forecast falling from 7.3 to about 6.9, but in general, particularly given a base effect, still significant demand coming out of that region. The Eurozone forecasts have been pulled back and starting to lift a little bit again now, particularly post some QE measures of the last little while. So the key message here is that global growth is still positive, and therefore companies across the world have that opportunity to continue to grow earnings, and we'll come to that again in a moment. One of the key features of asset prices has been record prices, not so much in overall equity markets, a number of markets hitting record highs, but certainly record prices in bonds, which on the flip side means record low yields. And that's certainly been a very interesting scenario, reflection of flight to safety, flight to quality, and search for any yield as official cash rates from governments around the world are effectively slashed to zero, still and at record low rates in Australia, with propensity to go slightly lower. We do expect the US rates to gradually edge up later this year, and bonds should start to follow, so official cash rates start to edge up in the US. But across the other regions we do not expect that, and so therefore you should expect lower for longer, interest rates lower for longer. What I'll do now is on slide 12 is just dive into some of the components of the global growth, just to set the framework. So US economic indicators remain very robust. Third quarter GDP 5%, strongest pace in 11 years, as that byline suggests. And you're starting to see upgrades to to US growth as a result of the efforts of the government and the Federal Treasury, Federal Reserve, making sure there's abundant liquidity, and therefore you've seen responses particularly in equity markets and of course record low yields. As I said before, we do expect interest rates to start normalising towards the back end of this year, and this may lead to a bit more volatility in asset prices, and that's the key market to watch for 2015, and also the key economy to watch in 2015. Slide 13 just has a little bit more depth in terms of the components of the overall economy. You can see that after a dramatic, on the left-hand side, the unemployment chart, after a dramatic fall in employment, you're starting to see the US economy respond, and unemployment coming back to cyclical lows of around 5.5%. Good signs, and one of the other indicators we look at is what's called the JOLTS report, which is really just an indicator of people quitting their jobs with the prospect of a better job coming up, and that's showing some really interesting signs of the propensity for labour in that market to really move and look forward to a better job outcome. So it's been a real success in the US. And confidence is improving, and no doubt we'll certainly look at consumer confidence numbers coming up over the next little while, particularly as lower oil prices start to hit the consumer pocket and a little bit more discretionary spending cash available. So something we'll be looking forward to. But certainly the US, in summary, a key market and a key economy to watch, and really has been the backbone of global growth over the last 12 months, and a real focus for all of us over the next 12 months. Moving forward to China. China will be a beneficiary of that US growth, i.e. exports out of China into an improving US economy, and that's reflected in that chart there, where it's largely tracking US GDP growth, and in light of that we're still getting growth in China of just around that 7% level. But I just noticed some interesting stats coming out of China with regards to iron ore, which is, the price is clearly under pressure, but China imported 933 million tonnes of iron ore in 2014, which was up nearly 14%, or 108 million tonnes over 2013. And despite that, inventories are still down, port stocks are still low, and the Chinese steel industry is benefiting from a significantly lower input cost, being iron ore. And one of the reasons for iron ore price being under pressure is that we are still adding to supply, largely through the Australian manufacturers or producers. And the key what I wanted to point out here is that as China still grows in a positive fashion, even though the rate of growth is slightly slower, the absolute size of China continues to see all iron ore produced being absorbed, and I think that bodes well for the demand-supply scenario over the next couple of years. But certainly I think iron ore price to remain under pressure over this current calendar year. and so those stocks exposed to that iron ore scenario are certainly under pressure with regards to earnings. Just on slide 15, Chinese economic indicators, they are adjusting well to the composition of growth, being transitioning away from production to consumption and less reliant on fixed interest. And certainly some of the anti-corruption measures are impacting significant parts of that Chinese economy, particularly the gaming markets in Macau, which are under a lot of pressure. I won't spend too much more time on the global economy. I'm happy to take questions later on, and we can address some of those. But just turning now to the Australian economic outlook, slide 17, as you move forward. The Australian economy is okay, starting to benefit from a lower Aussie dollar, and was trading below 78 cents overnight, and it's certainly been under pressure over the last few days in particular, as the bond market is pricing in a 100% chance of a rate cut in Australia on Tuesday coming up, and rumours are continuing to flow in that direction. I'm not as convinced that they'll cut rates. I think more than likely that the rhetoric from the Reserve Bank will indicate potential for cuts, but I do think they may hold that action as ammunition for the Australian economy in due course if there is any signs of significant weakening from any geopolitical shocks going forward. But I do think that they'll hold fire. We'll wait and see. The lower Aussie dollar is having some interesting impacts. Clearly offshore earners are benefiting from the translation, but more directly it should be good for domestic tourism. Less of us travelling offshore given a relatively higher cost, and inbound tourism also should start to benefit, as well as education inbound into this market. It'll be so therefore a good impact on consumer discretionary stocks in this market, and given the higher cost of buying offshore, some online shopping more directed to domestic producers as well, and I think that's again reasonable for domestic retailers, and it will address the impact from lower oil prices, which also should be good for consumer stocks going forward. Other economic indicators on slide 18 is you've seen the unemployment rate edge up from the lows in 2008 of about 4% up to about 6%, but it looks to be peaking. The economy is adjusting from the mining slowdown, and non-resource areas are starting to improve, and that's reflected in retail sales, which you can see some improvement on that right-hand chart on slide 18, and we do expect retail sales to have a reasonable outcome over this course of this next 12 months, given the reasons I just touched on, such as tourism, the benefit from lower petrol prices, and less online shopping or going offshore online shopping. The housing market on slide 19 continues to be a feature, and we've certainly got some stocks in the portfolios that are well positioned for continued improving in the housing market in terms of approvals being converted into starts, and we are at almost record numbers of permits or approvals, and that should translate into a couple of good years going forward for housing stocks. And in light of that, you're starting to get some price rises coming through on some of those raw materials, such as concrete. And housing as a percentage share of GDP will be contributing to GDP, as that outlook remains reasonably robust over the next 12 to 18 months. And if indeed interest rates are cut in this economy, I think that housing will be a beneficiary of that, certainly. Slide 20, just looking at some further economic indicators, some improving trends which are encouraging, particularly from that non-resource economy. Housing, which I have mentioned, trends remaining robust and a couple of years left to run in this cycle. Domestic cyclical stocks in light of that should be beneficiaries, particularly as consumer spending picks up, and again trends are starting to improve. And some of the key factors there really is lower, as we've touched on, lower A dollar. The housing market has helped. Low interest rates are certainly helping, and looking forward, lower petrol prices will certainly be putting more money into the consumer pocket, and with certainly some stocks will be benefiting from that. Turning now to the equity market, so moving forward through the slide pack onto 22. One of the key features through 2014 was a reasonable earnings outcome for the fiscal year ended June of plus 12%, but towards the back half of the calendar year, clearly with commodity prices weakening, earnings revisions have been coming down, reflected in this chart here, and that's largely a reflection of commodity prices and the big resource companies pulling back capital expenditure, and you can see that reflected on that chart. But nevertheless, business conditions, the trend is improving. Green line if you've got colour, and the darker line if you don't have colour on your slide deck. And we should see that overall earnings revisions outside the resources sector will continue to improve. And if I turn your attention to slide 23, and we'll just go through some of the valuations in the market. Overall, the market's not cheap, it's not expensive, around 15 times fiscal 15, and moving forward about 14 times for fiscal 16, predicated on earnings growth of 8%. The revisions have been negative, as I just touched on, and that's really from the resources sector, which have now gone from a positive to a negative 31%, and that's dragged down the overall forecast for the market to be negative 1% for fiscal 15. So the first time it's been negative for a few years. The resources do have some modest downside risk from here, but not overly significant. And all the other sectors there, just breaking down to the key components of the Australian equity market. Financials, I think reasonably achievable in terms of growth forecasts, about 7.6%, and valuations look okay. The REITs, again, some reasonable growth coming through in terms of rents, achievable 6.6%, yes, I think so. And industrials, particularly some of those offshore-facing industrials, growth forecast about 9.3%. I still think achievable, and forecast for further growth in 2016. So outside the resources sector, the overall market in terms of the major sectors are looking fine and solid, but its resource sectors have obviously been the big swing factor in the market. And that does have flow-on effects, of course, to the services sector, particularly mining and energy, and that sector, i.e. mining services and energy services, will be quite tough for the next couple of years. So I thought it was instructive to look on slide 24 to some of the valuations in the market, and this is looking forward-looking, so 2015. The overall market around 14 times, or 15 to 14 times, and going through various sectors. Energy and mining on the left-hand side, we expect PEs to rise despite stock prices coming down as earnings are downgraded. Financials, some interesting opportunities there. I think particularly in the banks, the market has been searching for yield and re-rating a lot of yield stocks, which is more on the right-hand side of that slide, of that chart. But banks offering some reasonable credit growth, we'll go into a bit more detail shortly, are offering some interesting opportunities. Our portfolios are overweight banks. Diversified financials, you saw some upgrades from Macquarie a couple of weeks ago, particularly from currency impact and some more volatility in markets. And I think REITs will continue to generate reasonable returns overall. Some of the cyclical industrials, there's certainly pockets of opportunities there, particularly in some contractors as the non-mining contractors will benefit from a strong infrastructure spend and construction spend coming up over the next few years. Media, you have to be very selective. The advertising is being highly fragmented, and costs still coming through, so you've got to again be very selective in cyclical media. I think retail is a strong area of opportunity. Those stocks tied into the housing market will be beneficiaries over the next couple of years, but also those factors that I mentioned, such as lower Aussie dollar, potentially lower interest rates, lower petrol prices, will certainly be coming through on the retail side, so some interesting opportunities coming through there. And transport, as a result of better activity in the market, some of those transport stocks looking quite interesting. And on the far right-hand slide, part of that slide, some of those defensive industrials are looking quite stretched, and the whole market has been searching for yield and re-rating those defensive and high-yielding sectors. and valuations are stretched, but there are nevertheless some opportunities within those sectors, but you have to be very select. And the forecast for interest rates potentially to go lower, I think they may over time, but not just yet. And the lower interest rates will certainly be supportive for some of those defensive industrial stocks and yield stocks. But overall, I don't see too much PE expansion across the whole market. And again, we need earnings growth to come through. And as I've pointed out, outside the resources sectors, that earnings growth is coming through. And therefore, you could expect a reasonable performance from the Australian equity market over the year. Just looking into some sectors on slide 25. Credit growth is improving both at a housing and a business level, and the outlook is reasonably robust. So the Australian banks are certainly seeing some earnings growth coming through, and together with the strong dividend yield of 5.5% with franking benefits, I do believe that the Australian banking sector is well positioned going forward, and I'll touch on one of the banks reporting, Commonwealth Bank, shortly. Nevertheless, companies are still conservative, individuals are still conservative, so debt repayment is still front and centre, but nevertheless we are starting to see some improvement in overall credit growth. Slide 26, I just picked this up off Deutsche Bank the other day, just looking at the pace of oil price correction. I thought it was quite instructive again. You can see that the fall has been quite dramatic. Certainly you've had a couple of years of improving supply, particularly with the energy revolution in the US. But the catalyst of not cutting back production and trying to balance that market has certainly been a very swift reaction in the oil price market, and really and frankly caught everyone by surprise. And clearly the energy stocks in this market have certainly been affected, and you're already seeing cutbacks as companies try and deal with a lower oil price. And it looks like, given that supply-demand dynamic, that we may see oil price under a little bit of pressure going through the next 12 months or so. It is very oversold on a technical view in terms of price, so it'd be no surprise to see a modest bounce back. But given overall supply and a little bit of demand weakening in certain sectors, I think the oil price will remain under a bit of pressure, unfortunately. Just looking through some of the key commodities for the Australian market on slide 27. I just touched on oil, so I do believe there's a technical bounce coming, but it will remain under pressure. Iron ore, given overall supply increase, particularly from the Australian producers, the outlook remains fairly weak there. And copper is now under a bit more pressure as well, given all of these commodity prices are priced in US dollars, which has been rallying quite strongly. The weaker commodities are certainly driving those earnings downgrades, as we touched on, down 30%, but I do think they will be coming to an end in terms of the downgrades over the next couple of quarters, and there will certainly be some opportunities across this market. And we are sifting through a lot of these stocks to identify some strong business models going forward, and it will be, again, interesting sectors over the next couple of years. Slide 28, just looking at the dividend yield and the payout ratios. Again, Australia is a high dividend paying market, particularly in financials and industrials, and yields around 5% make it this market globally attractive. And we are seeing money come for our yield stocks despite the weakness in the currency. The payout ratios have been trending higher overall, but I don't think there's too much left in the overall payout ratio in terms of growth. And as the economy adjusts to the fall in the mining sector and the improvement in the non-mining sector, I do think that companies will start reinvesting in their business, and payout ratios may not go too much higher, but in absolute terms I do think dividends will be quite a feature into this reporting season coming up, which takes me to slide 29. So the weakness in commodity prices is more likely to affect the second half of fiscal 15 earnings, so I think earnings growth will be biased towards this half, which is just reporting starting next week. And I do think overall, given there's been very few earnings warnings coming through pre-reporting, I think the overall reporting season will be quite solid. Clearly the overall forecasts are negative due to the commodity sector and downgrades in resource stocks, and cost control, particularly in those resource and energy stocks, have already come through, and the related services companies are certainly seeing margin impact there. But nevertheless, I think the rest of the market will be reasonably robust, and I think dividend growth will be a feature. I've touched on those payout ratios. One of the interesting angles on those payout ratios will be BHP and Rio in particular, which have committed to a progressive dividend. And with their earnings coming down, those dividends, I don't think in this half in particular will be under pressure. They'll certainly be questioned by investors, but those dividends in the next half will certainly be scrutinised in particular if those companies remain committed to that progressive dividend policy. Given low interest rates, balance sheets will be solid, and I do think there'll be some increased focus on buybacks. We did see Telstra in the last half report or initiate a buyback, and I think stocks such as Rio, which has been talking quite aggressively about rewarding stockholders, I think will come through with a buyback. And I think Amcor, given they've missed out on an acquisition opportunity and given strong cash flow, will likely to initiate a buyback in this half coming up as well. I think other features of the reporting season is offshore industrials will have a good experience, particularly with US operations and earnings. They should be strong, and translation effects will certainly be adding to the earnings growth going forward. Resource earnings, given the production reports have just come through this month, so they won't be too bad, but I think the outlook continues to be under a little bit of pressure, and therefore second half bias, and some of those commodities obviously offset by a weak Australian dollar. Domestic retail I think will be a bit patchy. However, we should have a better second half in terms of fiscal 15, and we'll be watching closely there. I'll come to some stocks in a moment, but some of the key portfolio thematics that we're currently running with. We're certainly favouring those international cyclicals, particularly in the industrials. Strong US dollar facing earnings streams are in focus. Some of the domestic cyclicals start to look interesting again, particularly in this second half. And some of those defensive stocks which have a reasonable yield and a growing dividend profile will remain in favour through this course of this year, particularly as we expect interest rates to remain low. I thought I might just touch on a couple of stocks which we'll be reporting this season and are quite indicative of some of those thematics. So Boral, which is the next stock to focus on. It has both domestic operations, Asian inclusive domestic operations, Asian operations, and US operations. I think all three factors will start to come into play this half, and you can see that this company will be a strong beneficiary of the improvement in housing starts, particularly in the US and particularly in Australia. We've been waiting a long time for the earnings to come through, and I think this is their time to shine. And we expect profits to be growing at 20% plus. And dividends to grow even more aggressively, about 33% in fiscal 15 over 14. They paid about 15 cents in 2014. I think it could be as high as 20 cents per share this calendar year, this fiscal year. And they are certainly restructuring their domestic portfolio. The joint venture with CSR on the BRICS has been announced, and they're looking to sell non-core assets. And looking forward, a robust housing market in the US and in Australia, particularly if interest rates stay low, and follow that up with this stronger infrastructure spend, should result in a couple of good years ahead for this company. Strong balance sheet, and we do expect this stock to be a key beneficiary. Turning to Commonwealth Bank on the next slide. It's the only large cap bank that is reporting. The other banks have September balance dates, but they will be updating the market in terms of quarterlies, and Commonwealth Bank will be the key one to watch. Some of the trends there, I did touch on credit growth, so lending growth should be solid, around 6% for housing, 4% for business. Net interest margins should remain okay, and bad and doubtful debts at cyclical lows. and we do expect the dividend to rise modestly, and they paid about $1.83 last February. The consensus is for $1.97 coming up, i.e. nearly $2 a share, and I think the outlook for banks is pretty good for this calendar year. Regulatory risk is largely behind these banks now, or at least acknowledged or known, and therefore should have a solid year. I was just doing some quick stats on CBA for interest. Prior to this dividend, CBA has paid out $42.68 in fully franked dividends since its IPO in 1992, and that IPO was $6 a share. And if you'd held that stock through that time, you've picked up all of those dividends, and the capital price of the stock is up nearly 15 times to about $88 as well. So it's been an amazing stock to hold, and been a key one for self-managed super funds to be holding, and the outlook again pretty solid for the 12 months coming up. Some of the interesting stocks will be energy stocks in particular. I think that Santos, which has been in our portfolio unfortunately, given that we were focused on the strong cash flows coming forward with the LNG projects in Papua New Guinea and Gladstone coming through, I think that stock will be under some continued pressure, particularly on its balance sheet and how it addresses some pullback in capex. But it's largely released its production through the quarterly, and they've guided to some lower costs, and the overall weak oil price will really have an impact until the second half, and the focus will be on the GLNG startup and the guidance there, and the balance sheet repair with either a hybrid issue or an underwritten DRP, maybe even asset sale with the pipelines. The other key resource stock to watch is Woodside. That stock has been, it's under a bit of pressure over the last quarter or so, but that stock had been well bid over the course of the last 12 to 18 months, rightly so, on the company paying out a greater proportion of its earnings in the form of dividends, and it started to get re-rated as a yield stock. But given weakness in commodity prices, there's every expectation of quite a significant dividend cut coming to that stock. So it's buyer beware in some of these energy stocks as the companies start to pull back, and that won't be a sector that's focusing on returns to shareholders. They'll be more focused on business profitability and survival in case of some of the smaller cap stocks. The last two slides on 33 and 34 are just looking at some of the tilts that are currently in the portfolios. In the large caps, you can see the active tilts on the far right hand side. A number of those stocks are thematically positioned for improving economies in the US in particular, and a gradual rise in interest rates in the likes of QBE, and good performances, cyclicality with regards to 21st Century Fox, which has actually exited the Australian index. Lend-Lease should be a beneficiary of improving construction, and other stocks there should be well positioned for the weaker Aussie dollar, Boral, ResMed, Aristocrat, Brambles, etc. So we're more overweight banks now, we're underweight energy, we're underweight resources, but nevertheless looking for opportunities within those sectors, and that's also reflected in the emerging leaders on the next slide, where there's good opportunities that will be coming up over the back half of this year, and some good exposure to stocks that have offshore earnings, such as ResMed, again reflected in this portfolio, like the large cap. Seek should be a beneficiary, as will Aristocrat Leisure, and as well as some domestic cyclicals such as Cube, Dick Smith Holdings in the retail space, and Harvey Norman, which will be a beneficiary of increased consumer spending and activity in the housing sector. I think I'll finish it there. I do have some questions that have already come through. I just might address a few of those, given the 5 minutes remaining. And if I haven't answered your questions, I'll endeavour to do that through the course of the next couple of days, and very happy to answer those. One of the questions that has come through is that can the Australian economy generate growth? And my short answer to that really is yes. There are some of those green shoots which we've just touched on in the non-resource economy. There's reasonable consumer sentiment and business sentiment, and both borrowing and capex are up. Consumer is on an improving trend, and if there are rate cuts, they would certainly help further. So I think overall the Australian economy should generate growth, and again that's reflected in some of the earnings growth that we've touched on, particularly in those non-resource sectors. Another angle on that is the question coming through is, could the labour market weaken and drag down the economy? It's just come through. Possibly. However, lead indicators like the NAB survey and the ANZ jobs survey actually suggest conditions are reasonable. Jobs growth in construction, real estate and professional services, i.e. the non-resource economy, will offset some of the job shedding in the resources, government and manufacturing. So overall, as I mentioned earlier, I think the unemployment rate is peaking. There's clearly going to be a little bit of weakness in the resources sector, but I think the overall economy should be okay. And again, the RBA has some further bullets to fire by lowering interest rates to help stimulate activity. Another question has just come through is there much left in the housing story? I think I did mention that yes, that the opportunities as permits or approvals convert into construction activity, I think the next couple of years are solid for that sector, particularly if interest rates are slightly lower. So approvals are high, we've got construction ramping up, we've got infrastructure spend coming through in the next few years as well, and we are starting to get some price rises in materials, and I think housing plays look good value as well, equivalent to a market P, and I think that will continue. Another question coming here, Julie, will yield remain popular? I think yes it will. Yield stocks continue to remain in favour as interest rates remain low globally, outside of the US, which we do expect to rise later in the year. And whilst yield stocks have re-rated, there are pockets of opportunity. And banks in particular are looking quite interesting on a relative basis to some of the infrastructure and REIT stocks. And those stocks that have yield and yield with growth will certainly come into favour there. So I think there's certainly opportunity to sift through quite a few opportunities there. Another question here, has the resource sector finished dragging down the market? That's a good question. The resources market, I did show that chart where the market cap of the resources as an overall percentage of the market has been reduced quite significantly. So whilst earnings downgrades are coming through, I think the overall impact won't be as pronounced as it has been, and I think that they are close is probably the best description to be dragging down the market. I'm getting the finishing up sign now, so I will stop there. I do appreciate your attendance on the webinar. Thank you for those questions, and I will endeavour to get through to the balance of the questions if I haven't answered those so far. Thank you very much.